And recently, money is being pulled away from the venture capital world, and these are some stats here. So this is from Thompson and the National Venture Capital Association. And basically, aggregate numbers over the last 2 years, so starting in 2007, 2008, 2009, what's happened in the venture capital world. And you can see the number of venture funds that have fundraised is down 50%. And the amount of money that they've raised is down 66%. So what that means is that people are not satisfied with the returns that venture capitalists have been delivering back to them. And so you saw Ohio's, they're only going down a third, but the industry is going down much greater than that. April 12, 2010, this was the New York Times, a U.S. venture capital firm raised $3.6 billion in the first quarter of 2010 from 32 funds. And on the face, that sounds like a lot, but it says this level marks a 31% decline compared to the first quarter of 2009 and 44% decline in the number of funds. Also represents the slowest opening quarter since 1993. The point being is 2010 could be worse than 2009. And so you could have 3 years of decline, and if we're already at 66% less money or fewer dollars in the industry, you know, the worry is it could be down 88% from 2007 highs. And you know, what does this mean for entrepreneurs? And that just means that the competition just got a whole lot harder. You know, there's a lot fewer dollars, a lot fewer doors to knock on, a lot fewer yeses. And so there's just a very heightened pitch right now among the startup and entrepreneurial community and the, you know, the venture capital world. The venture capitalists that survive like it. There's less competition. Valuations go down. There's not 10 people, you know, getting excited about it. There's 1 or 2 because all their friends are out of business. There's an opinion among institutional investors like pension funds and foundations that this is a good thing because the competition, there are too many funds pushed up valuations, so exits were less, so returns were less, and that's what's caused kind of the gluttony. Yes, question?
So the money's still out there, right? They just shifted it to somewhere else. And you expect that if it all shifted to stocks, you should see the stock price shoot up significantly on the overall market level. Where's the money going? Are they just sitting on it?
So the money is shifting. So the question is, where'd the money go? Because we're assuming that it didn't disappear. It's just moving out of venture capitalists. So it is going to other places. It's going towards other strategies in the private equity allocation world. It's going to distressed. It's going to buyout. It's going to, you know, mezzanine, other things, and it can come back. It's going towards just sitting on cash for a little bit. There's a movement that just says, let's just breathe here for a little bit. Let's just take a year or two and see where the right strategy is for our money. You have been seeing that there has been an increase of allocation to the private equity space, but a decrease in the venture capital space. So it's staying in the space, it's just not going into venture capital. So moving forward, how do venture capitalists and private equity professionals make financial decisions? So since this is about money, since they wake up in the morning because they want to make money, you know, what drives them in their decision-making process? And you know, basically, they're in this for returns, and returns means they put $1 in, they get $2 back, or they put $1 in, they get $3 back, and they want it to go in. They want as much money back as possible, and they want it back as fast as possible. And we're going to talk about why that is. But limited partners like the Utah Fund of Funds and others, they're happiest when the checks are fat and it comes back in less than 20 years. They want it back in 3 to 5 to 6 years. They don't want to see it out there 10 to 12 to 15 years out. You know, a successful fund means a lot more money. If you're a successful fund, there's the haves and haves not. If you're successful, a lot more money runs to you. Your legal documents get a lot more relaxed. You get a higher management fee. You get a higher piece of carry, which is the profit sharing on the back end. So to be successful in this industry can be extremely lucrative. If you're not successful, you're just working really hard for not a whole lot. And kind of 10 or 15 years into it, you haven't made much money, and now you're kind of out of a job because no one else will invest in you. So it can be a difficult industry.